Hello everyone, welcome to EduTap and welcome to Finance 360-degree session. So today we are going to discuss two very important articles. The first one is regarding the prudential norms on specified non-financial asset acquired by regulated entities. So what is this specified non-financial asset? How is it acquired by the regulated entities? What are the norms that are related to the specified non-financial assets? So all of this we are going to discuss in today's session. The second news article is regarding the Reserve Bank of India Compliance Function Directions 2026. So what are these compliance functions and what is their compliance risk? This we are going to discuss in today's session. Okay. So today we are going to discuss some important articles from your end of the July 2026 so that you have the idea that okay, what are the different terms all about, because in the RBI notifications it has been seen that the terms they keep on repeating, or if you understand the terms one time then it becomes easier for you to understand the later on notifications before the examination. Okay, so today we are going to discuss these two notifications, or today we are going to discuss these two articles from the RBI website. Now, RBI website is very important from the examination perspective. In this year, in the phase 1, there were less number of questions from the RBI website. Around 6 to 7 questions were there from the RBI website in the phase 1 in 2026 RBI Grade B examination. But in phase 2, there were multiple questions from the RBI website. Okay, there were descriptive questions. 2 to 3 descriptive questions were there from the RBI website in the FM section, as well as there were also objective questions from the RBI notifications, RBI press releases. So next session, I am thinking of taking a session on the detailed discussion that what kind of questions come from the RBI website in the examination and how much questions were there in the phase 1, how much questions were there in the phase 2. In the next session, I am thinking of taking a detailed session so that you have the idea that how much in depth you have to study from the RBI website and what do you have to study from the RBI website. Okay, so this is what we are going to discuss in the next session. But let me tell you that the RBI website, the RBI notifications, RBI press releases, they are very important, especially in the descriptive. In the phase 2, we have seen there were multiple questions in the phase 2. Okay, in the phase 1 also there were some questions that we will have a detailed discussion in the next session. Now, coming to the today's topic. Hello everyone, good morning. Welcome to the session once again. So today we are going to discuss two topics. The first one is prudential norms on specified non-financial asset acquired by regulated entity. So think about it that let's say the bank is giving a home loan to Kavya. Now the bank will take what as collateral? If bank is giving 1 crore rupees as home loan, so Kavya will have to give collateral security to the bank. Now this security will be in the form of home. If Kavya is taking home loan, Kavya will have to give her home as collateral, or her home papers, the kagzat that we call, or the papers of the home, the ownership of the home, that ownership papers will be shifted to the bank, right? So this is the idea that if you are taking loan from the bank, if you are taking car loan, you will have to give your car as the collateral, or you will have to keep the car papers as the collateral with the bank. If you are buying any property, any land, you are taking the land loan, so your land will be kept as collateral, as security with the bank. Okay, the land papers. So this is the basic idea that if you are taking loan from the bank, you will have to give some collateral, you will have to give some security to the bank, so that if you default, if Kavya defaults, this house can be sold to get the money for the bank. Okay, this is the basic idea. Let me open the explanation part so that I can explain you in a better manner. So here you can see that let's say the bank A is providing loan to Kavya. So Kavya will have to give collateral to the bank for the security of the bank, that so that if Kavya defaults, the collateral, the home, the land, the property can be sold for the bank to retrieve the money. Okay, so when Kavya will default, or when someone defaults and they are not able to pay the interest, they are not able to pay the principal to the bank, then the bank has the right to sell this collateral, this security. That is the idea. Okay, so the specified non-financial asset, they are non-financial asset. That means your house, your land, that you have kept as collateral. So they are the non-financial asset. Okay. Now banks primarily deal in financial assets such as loans. The banks give loans, they take deposit, they can also invest in the markets. So they do not normally acquire or hold immovable properties. That's why the banks, they are different from the real estate sector. In the real estate sector, there are the builders, there are the construction workers, there are the owners also, there are the real estate developers and such. So basically the real estate segment is different and the banking segment is different. Banks, are they engaged in buying and selling of the land? Are they engaged in building of the factories, construction of the buildings and such? No, the banks are engaged in the basic financial activities such as providing the loans, taking the deposits, or doing the investment in the markets and such. So the real estate segment is different from the banking sector. The banks are majorly, they are primarily dealing in financial assets such as loans, deposits, investment. They do not normally acquire or hold immovable property. That means they do not normally acquire or they do not normally hold the land, buildings, factories or warehouses as part of their regular business, because their regular business is not related to real estate. Their regular business is related to the loans, deposits and such. So the real estate segment is different. The builders, the construction authorities and such, they are different, and the banks are different. The banks, they do not acquire or hold immovable properties as part of their regular business. However, when a borrower fails to repay a loan, the bank may sometimes acquire the borrower's immovable property. So bank, they are not directly engaged in the real estate activities. They are not in the business of the real estate, right? But bank also acquire immovable property such as the house, land, property. So bank acquires this immovable property. This immovable property is acquired by the bank in as the collateral or when the other party defaults. Okay. So bank can acquire the property. So when a borrower fails to repay a loan, that means the borrower is doing a default. In this case, bank may sometimes acquire the borrower's immovable property in full or partial settlement of its outstanding dues. Such properties are commonly referred to as non-banking assets, acquired in satisfaction of the claims because the other party has done the default. So now what's new? RBI has now introduced a comprehensive prudential framework for the immovable properties, that what should be done with these immovable properties, till what time the bank can hold these immovable properties that is acquired by the banks against the stressed loans. Now if let's say Kavya has done the default, so this loan will be called what? This loan will be called non-performing asset if the Kavya is not paying the principal amount, or the Kavya is not paying the EMIs, the Kavya is not paying the interest amount and such for a period of more than 90 days. Then the loan will be called non-performing asset. The payments are not coming for this particular asset, for this particular loan, because for the bank, the loan is the asset on which the bank is earning the interest. If the Kavya defaults, that means this loan becomes non-performing asset. Now the bank is not receiving payment on this loan. Okay, this is the idea. Now the RBI has introduced a comprehensive prudential framework for the immovable properties acquired by banks against the stressed loans. Such properties have now been formally defined as specified non-financial asset. So the land, the property, the house, these are the immovable properties. They will be called specified non-financial assets. These are the big assets that the bank is acquiring. This is the immovable property that the bank is acquiring. Okay, and the bank cannot hold it for a very long period of time, for 50 years, 60 years. Bank cannot hold it. Bank will have to sell it out, because the bank cannot deal in the real estate for a longer period of time. That is the idea. Now applicability of the direction. These directions applies on the banks such as commercial banks, small finance bank, NBFCs, all India financial institutions, urban cooperative banks, rural cooperative banks, RRBs and local area banks. Now if you can see, the payment banks are not mentioned here. Why the payment banks are not mentioned? Because payment banks, they cannot give the loans. Remember this, payment banks cannot give loans. Okay. Enforcement of the direction. These directions shall come into force from 1st October 2026. Now, The RBI has now defined specified non-financial asset. So specified non-financial asset means an immovable asset acquired by the bank in full or partial satisfaction of its claim against a borrower, including non-banking asset. So basically, specified non-financial asset, these are the immovable asset such as the property that is acquired by the bank because the other party has defaulted. Now, SNFA may be acquired from the borrower against full or partial extinguishment of the bank's exposure. Now, think about it. Let's say that the total loan that was provided was 100 lakh. Okay, 100 lakh. This was the total loan that was provided to Kavya. Now, extinguished portion means that this is the portion that can be covered by the collateral directly that the Kavya has provided. Okay, so Kavya has provided the collateral such as property. Now this property is directly able to cover 60% of the loan. Right now the valuation was done and it was seen that the property now is only able to cover 60% of the loan, that is 60 lakh rupees. This is covered by the property. Now remaining loan is 40 lakh, 40%. This is not getting covered by the property. As per the evaluation, it was seen that 40 lakh, that is 40% of the loan, it is not getting covered by the property, okay, or by the land or by the house, whatever the collateral is. So SNFA, this immovable asset, it may be acquired from the borrower against full or partial extinguishment of the bank's exposure. Maybe the full exposure, that is the 100 lakh, this full amount might be covered through the property 100%, or there might be partial extinguishment or partial coverage that the collateral is providing. It means now it is on a non-recourse basis. That means once a particular part of the loan has been settled against the property, it has been clearly said that 60% of the loan will be settled against the property. So this 60% is the extinguished portion of the loan. Now the bank cannot later revive that extinguished amount merely because the property is sold at a lower value. So as per the valuation that the bank has done, the property now is worth 60% of the loan amount. So this is the extinguished portion. The bank has said that okay, your 60% of the loan is getting covered by the property, you just have to pay the remaining amount, or your 90% of the loan is getting covered through the property, that is the extinguished portion, you just have to pay the rest of the 10%. So if there is the extinguished portion that has been decided later on after 2 years or 3 years, if the bank is selling that property, now the bank cannot say that no, actually the loan that was repaid through the collateral is only 40% or 30%, you have to pay the rest amount. This cannot be said by the bank. That's why it is on the non-recourse basis. If the bank has once explained or once has decided the partial extinguishment, that what is the extinguishment percentage, or the full extinguishment is if it is happening, if the bank has once stated that, now the bank cannot say that the extinguished portion is being revived. The person has to pay more just because the property is sold at a lower value later on. I hope this is very much clear. Any confusion here? If basically Kavya's extinguished portion through the property, Kavya's extinguished portion was 60%. So even if later on the property is being sold for even lesser, let's say for 50 lakh only, but the bank cannot take the more amount from the person because the bank already stated that this is the extinguished portion. If the bank is able to sell at 50 lakh, that is the mistake of the bank. The bank did wrong valuation before. Okay, this is the idea. So SNFA may be acquired from the borrower. The immovable asset acquired from the borrower can be for the full extinguishment, 100% of your loan is getting covered, or 100% of the amount is getting covered, or partial extinguishment, only 60%, only 70%, only 90% of the bank's exposure is getting covered. Whatever it is on the non-recourse basis. Non-recourse basis means that once a particular part of the loan has been settled, either partial, full or partial, whatever percentage of the loan has been settled, once it has been announced, the bank cannot later revive that extinguished amount merely because the property is sold at a lower value. I hope it is very much clear. Now, SNFA shall be acquired only in cases where a bank's exposure to a borrower is classified as non-performing asset. Think about it. Kavya is paying her regular payments for the loan to the bank. Kavya is paying regular payments, but still Kavya's property is being taken over by the bank. Is it allowed? Think about it from yourself. You are paying regular EMIs for your home loan, but still the bank is trying to capture your house. The bank is trying to take over your house. Should it be allowed? No, it is illegal. Basically, bank cannot do it. If you are paying your loan amount regularly, the bank cannot take over your property. That is the basic idea. So this is the idea that SNFA, that is the immovable property, shall be acquired by the bank only in cases where the bank's exposures to a borrower is classified as non-performing asset. Okay, so this is the idea. Let me just give you one condition. Let's say that again Kavya has taken the loan, home loan or property loan from the bank. Now Kavya has kept her house papers as collateral, as security with the bank. Okay, now Kavya is using the house. She is living in the house as the owner. Just the papers are with the bank. Just the papers are being kept with the bank. Now, if Kavya defaults, if Kavya is not able to pay, and for 90 days, for more than 90 days, she has not made the loan payments, okay, which should have been done on the monthly basis, but for 3 months she has not done any payments to the bank. Now the bank can take over the collateral. Now the bank can ask Kavya, first of all, notices will be sent. If Kavya is still not paying, then this house will be taken over by the bank. That is the idea. Okay, so an SNFA shall be deemed to have been acquired by the bank only if the title of the asset, like I've told you that the house is still being used by the Kavya, is still in on the name of Kavya, okay, but the property papers are with the bank. So SNFA shall be deemed to be to have been acquired, the immovable property have been acquired by the bank only if the title of the asset is transferred in the name of the bank and the bank is in the clear position to deal with the asset on its own, to sell the asset, to do whatever with the asset. Okay, upon acquisition, now the asset has been acquired by the bank. So upon acquisition, SNFA shall be recorded in the balance sheet at the lower of the net book value of the extinguished exposure or the distress sale value. Now what does this mean? So that's why I've brought this example so that you have the clarity. Let's say that the total loan was of 100 lakh. Extinguished portion means that the collateral is able to cover the house or your property, is able to cover the 60% of the loan value. Now the remaining loan is 40% that you will have to pay. Okay, so your collateral is only able to cover 60 lakh rupees. Now always whenever the bank is giving the loan, the bank is expecting to make bank is expecting that the other party might default. So bank has to make the provisions. So if the bank is giving loan, the bank is also making the provisions. Let's say here the bank is having the provision of 30%. So bank already has covered 30 lakh of the loan. That means for extinguished portion, 30% of 60 lakh, that is 18 lakh of the provisions the bank is maintaining, and for the 40 lakh, 30%, that means 12 lakh. So in total 30 lakh of the provisions the bank is maintaining. Okay, 30%, that is 30% of the provisions the bank is maintaining. Net book value is your gross outstanding minus the provisions, because the provisions is considered that okay, the bank has kept the safety net with itself. So this much is the provisions that the bank is keeping. The gross outstanding minus the provisions, this is the net book value. So net book value is how much? 70 lakh of the total loan. Extinguished portion, that means provisions are 18. So extinguished portion is 60 lakh minus 18 lakhs are the provisions, so 42 lakh is the net book value of the extinguished portion. Okay, so I hope this is clear. First of all, that what is the book value, net book value of the extinguished portion. Net book value of the extinguished portion is nothing else, it is the extinguished portion or the outstanding amount minus the provisions. Okay, minus the provisions. Now here we do not take the total provisions, we take the provisions, that is for the amount. So the provisions are 30%. Okay, so 30% of 60 lakh is 18 lakh. So these are the provisions for the extinguished portion, and for the remaining loan 12 lakh are the provisions. So total provisions are 30 lakh. Okay, that is the totality of this. Now, so net book value of the extinguished portion is 42 lakh. Now let's say that the distress sale value, as per the two independent valuers, there will be two independent external valuers that will be hired to value the property. Now after 2 years, when the bank is selling the property, or now when the bank is selling the property, so now the independent valuers have said that this 50 lakh is the value. This is the distress sale value, that if the property is sold on the immediate basis, 50 lakh the bank will be able to retrieve. So net book value of the extinguished portion is 42 lakh, while the distress sale value is 50 lakh. Okay. So this is the idea, that upon acquisition, SNFA shall be recorded. The asset shall be recorded in the balance sheet at the lower amount of the net book value of the extinguished portion. So whatever is the lower amount, the net book value of the extinguished portion or extinguished exposure, or the district sale value of the SNFA. So net book value of the extinguished portion was 42 lakhs, while the distress sale value of the SNFA was 50 lakh. Okay, so the lower, that is the net book value, will be recorded in this case in the balance sheet, because the record has to be maintained, right? The record has to be maintained. So this is the basic idea, that upon acquisition of the property, the SNFA shall be recorded in the balance sheet at the lower of the net book value of the total loan, or the extinguished loan of the extinguished portion of the loan. Okay, so net book value of the extinguished exposure or the distress sale value, whichever is lower, that will be recorded in the balance sheet. And distress sale value will be arrived by at least 2 independent external valuers. Whichever is the lower of the 2 valuations, that will be kept as the distress sale value. Let's say one independent valuer is saying that the distress sale value will be 55 lakh, another independent valuer is saying 50 lakh. So the lower of the valuation will be kept as the distress sale value. I hope this is clear. Any confusion? Any confusion, anyone? So this is the table that you can read, where you can see the total loan amount, the extinguished portion, and the remaining loan. Now the provisions are 30%. So on the total loan, the total provision is 30 lakh. If we divide it into 2 portions, that is extinguished portion, for that the provisions are 18 lakh, and for the remaining loan the provisions are 12 lakh. That means in total 30 lakh. Net book value is basically the gross value minus the provisions. So that is the net book value. So net book value of the extinguished portion and the applicable distress sale value of the collateral. The collateral distress sale value is 50 lakh, lower of the 2 valuations that we have arrived at. Okay, so this is the idea. Remaining loan, now the bank will have to see the enforcement of the residual collateral, if there is any additional collateral that will be used for the remaining loan, or compromise will be done, or one-time settlement can be done with the borrower, that okay, at one time just pay 20 lakhs instead of 40 lakhs, or pay 30 lakhs or something. Okay, so that is the idea. So I hope this is very much clear. A bank shall dispose of the SNFA within a maximum period of disposal as envisaged in the bank's policy. So as per the bank's policy, the SNFA has to be disposed of. That means it should be sold. So the sale has to be done in the maximum period of the disposal as per the bank's policy, subject to a maximum period of 7 years. That means RBI has said that as per the bank's policy, the maximum period of disposal for the asset can be 3 years, 5 years, but it should not be more than 7 years. So the asset has to be sold as per the bank's policy within 3 years, within 5 years, within 6 years, but it should not be more than 7 years. It should not be more than 7 years. Within the maximum period of 7 years, this property has to be sold out, okay? Because the bank should not be holding the property. The bank should not be keeping the real estate, because the bank is not in the business of real estate. The bank is in the business of financial assets and such. The bank cannot sell the SNFA back to the original borrower or any related party of the borrower, okay? Because you can see that the distress sale is happening. So here the bank cannot sell the property back to the original borrower or the related party. So this was all. The applicability of the directions are on all the financial entities that are providing the loan. The payment banks are not amongst these, because the payment bank do not provide the loan. Enforcement of the directions are from October 1st, 2026. Now SNFA we have discussed, it is the immovable property, okay? Now the collateral can do the full settlement or the partial satisfaction of its claim of the loan. So the collateral can cover the full value of the loan or the partial value of the loan. If the partial value is happening, that means that means there is the extinguished portion that is there. Okay, so if the partial coverage of the loan is happening, that means there is the extinguished portion that we have to see. Now, conditions for acquisition: the SNFA must be acquired by the bank so that the bank can sell the property. Okay, and the full extinguishment can happen for the collateral, like the collateral can cover the full amount of the loan or the collateral can cover partial amount of the loan. So completion of acquisition: the title of the asset must be transferred to the bank. The regulated entity is in a clearer position to sell the property. Valuation and balance sheet recognition: so we have discussed in the balance sheet. In the balance sheet, basically the lower of the net book value of the extinguished exposure or the distress sale value of the SNFA, that will be recorded in the balance sheet. That is it. And the disposal of SNFA subject to overall maximum. So the SNFA, that is the asset, immovable asset, it has to be sold within the maximum period of 7 years. The lower period can be like the bank policy. As per that, the asset can be sold in 1 year, 2 year, 3 year, 4 year, 5 year, 6 years. But the maximum, like the RBI has stated, that the SNFA has to be disposed of overall maximum period of 7 years. Now coming to the next article, that is your compliance function. Okay, so I hope the first article is clear. Now coming to the second one. Reserve Bank of India compliance function directions. See, compliance risk. First of all, what is compliance risk? Compliance risk is the risk of legal or regulatory sanctions. The RBI imposed sanctions on the Paytm Payment Bank. Before the license was cancelled, before that, Paytm Payment Bank was imposed with the sanctions that it cannot take on new customers, it cannot take more deposits from the customers. Okay, so there were some sanctions that were imposed on the Paytm Payment Bank before it was cancelled, before its license was taken. So compliance risk shall mean risk of legal or regulatory sanctions by the regulator or material finance loss, that is financial loss or loss to reputation. So compliance risk, let's say the bank, it is not following the rules and regulations of the RBI. The bank is not working in the benefit of the public. The bank is working against the benefit of the public. So what will happen, that the RBI will be imposing some restrictions on the bank, that okay, this bank is not working properly, Paytm Payment Bank is not working properly, or XYZ bank is not working properly. So the bank's reputation will be tarnished because the RBI, that is the monetary authority, it is saying that okay, this bank is not working properly. That means there is some problem with this bank. So compliance risk is basically when the regulated entity, it is failing to comply with the laws, with the rules and regulations related to the self-regulatory organization standards and codes of conduct applicable to its activities by the RBI. So if the regulated entity that is regulated by the RBI, if it is not following the rules and regulations of the RBI, if it is not following the laws, if it is not following the rules set by the self-regulatory organization, the SRO, under the RBI. So if it is not following the rules and regulations, if the regulated entity is not following the rules and regulations, that means it is under the compliance risk. It can be imposed with the regulatory sanctions, legal sanctions. It might have financial loss because of not following the rules and regulations. It might have the loss to reputation. So this is the compliance risk, that if you do not comply, if a bank, if a regulated entity do not comply with the rules and with the laws, with the rules and regulations of the RBI, with the rules and regulations set by the SRO, self-regulatory organization authorized by the RBI. So if the regulated entity is not following the procedures and the compliances, then it will be under the compliance risk. It might have the loss of reputation, loss in the financial terms. It might have some sanctions. It might get some sanctions. Okay, so this is the idea. So this is the compliance risk. Therefore, regulated entities, they require an independent and adequately resourced compliance function to identify, assess, monitor and report the compliance risk, that where the compliance risk is. So first of all, the compliance risk basically means the risk of legal or regulatory sanctions financial loss or loss to reputation because of not following the rules and regulations. Therefore, regulated entities, they require an independent, adequately resourced compliance function so that they can comply. And if there is non-compliance, then the regulated entity should immediately do the rectification of the actions and should start complying with the rules and regulations so that its reputation is not tarnished and such. To create a comprehensive framework for managing the compliance risk, to reduce the compliance risk, the RBI issued the Reserve Bank of India compliance function for the regulated entities, for the banks, NBFC and such. Okay. Now the banks must conduct a compliance risk assessment at least once every year. So on the yearly basis, the bank is seeing that is it following the rules and regulations, is it doing the compliance function, and what is the compliance risk, where the problem is coming, which particular area is in the risk category, the loan segment, the home loan segment, or the MSME loan segment, maybe in the micro, small and medium enterprise lending that the bank is doing, the bank is not following some rules or some regulation. So bank can see that, okay, in this particular segment, there is some compliance risk that is arising. We are not following this particular norm of the RBI that we have to start following. Okay. So the banks must conduct a compliance risk assessment at least once every year. To ensure that the compliance function remains effective, every bank must establish a quality assurance and improvement program. Okay. So to ensure that the compliance function remains effective, the compliance is being done with all the norms, all the rules and regulations, every bank must establish a quality assurance that the bank is maintaining the quality, the assurance is there that the bank is maintaining quality in the different segments. An improvement program, if there is any loophole, if there is any area where the compliance risk is arising, where the compliance is not very strong, so that area can be improved, covering all aspects of its compliance framework. This program must be independently reviewed. So to ensure the compliance function remains effective, every bank must establish a quality assurance and improvement program. Quality assurance and improvement program, that the quality is being maintained, the compliance is being maintained, and there should be improvement program wherever the compliance risk is arising, that has to be improved, that area has to be improved, and this program must be independently reviewed by an external agency at least once every 3 years. So this is the idea, that is compliance risk assessment once every year. Compliance risk assessment should be done, that where the compliance risk is arising, there should be a quality assurance and improvement program that should be reviewed every 3 years. Once every 3 years. Okay. So that the quality assurance is there, the improvement is happening in the compliance of the bank. Every covered bank must establish a compliance department at its head office. The department must be headed by the chief compliance officer. Okay. The chief compliance officer may be selected from within the bank or recruited from outside. So that can be done. So there should be a compliance department that can see that, okay, the compliance is being maintained or not. And under the compliance, like the department should be headed by the chief compliance officer. Now, eligibility conditions for the chief compliance officer. At the time of appointment, the chief compliance officer should ordinarily not be more than 55 years of age. However, a person who has been continuously associated with the compliance function since before attaining the age of 55 may still be eligible. So basically the chief compliance officer, the compliance officer should not be more than 55 years of age, but let's say that the person has vast experience in the compliance domain, the person has been continuously working in the compliance domain. So even if the person is 55 years of age, doesn't matter, the person can be hired as the chief compliance officer because the person has vast experience in the compliance domain. Okay, this is the idea. So appointment of the CCO should ordinarily not be more than 55 years of age. CCO should not be ordinarily more than 55 years of age, but if the person has been continuously associated with the compliance function since before attaining the age of 55, they may be eligible. The candidate must at least have 15 years of experience in banking or financial services. This is minimum experience that is required in the banking or financial services of 15 years, including a minimum of 5 years of experience in audit, finance, compliance, legal or risk management functions. Okay. Independence of the CCO's office. So chief compliance officer's office should be independent. To protect the independence of the office, the CCO must be appointed for a fixed tenure of 3 years, of at least 3 years. Fixed tenure of at least 3 years, so that the compliance officer has the time to take to identify the mistakes, to ask the bank to resolve the mistakes, and the compliance officer is working for at least 3 years of tenure. So before that tenure, the compliance officer cannot be taken out of the bank. The CCO must be a senior executive, preferably of the rank of general manager or equivalent, and must not be placed more than 2 levels below the MD and CEO, so that the CCO has the power, because the CCO is also a senior executive that has some say in the bank. CCO shall have direct reporting lines to the MD and CEO, that if there is any compliance mistake that a particular department is doing, the direct resolution can be seeked from the MD and CEO. So the CCO should have a direct reporting line to the MD and CEO, or to the board of the directors of the bank, or to the ACB, that is the audit committee of the board of the bank. In case the CCO reports to the MD and CEO, audit committee of the board shall meet the CCO quarterly on one-to-one basis without the presence of the senior management, including the MD and CEO. So basically, let's say that if the CCO is directly reporting to the MD and CEO, it might happen that the MD and CEO ask the CCO to not, like, okay, this compliance risk is happening, it's okay, we will take care of it. Now if it is the meeting is happening with MD or CEO, then the CCO should also have the quarterly meeting on one-to-one basis with the audit committee of the board, so that to the audit committee of the board, it can be informed that, okay, this compliance risk was there, and it has been informed to the MD or CEO. So without the presence of the senior management or MD or CEO, there should be one-to-one meeting with the audit committee of board, so that the audit committee of board also is aware that, okay, where the mistake is happening, what are the compliance risks that are arising. The CCO must participate in quarterly discussion with the RBI to explain the bank's compliance position and discuss any regulatory concerns if there are any. If such a discussion is not held, the CCO must personally meet the concerned Chief General Manager of the RBI's Department of Supervision once during that quarter, ensuring regular communication between the bank and its regulator. That is the idea. So this is all. I will show you some questions, but before that, we have discussed that there is the compliance risk assessment that should be done by the bank, quarterly assurance and improvement program. Compliance department should be there, and that should be headed by the CCO. The CCO should not be more than 55 years of age, but if the CCO has the the person has the experience, then the person can be more than 55 years of age if the person has experience in the compliance domain. Minimum 15 years of experience in the banking financial services, and minimum 5 years of experience in audit, compliance, legal and such. Fixed tenure of the CCO should be there for 3 years, so that for 3 years the CCO is working and the CCO has the power for 3 years at least. Seniority should be there for the CCO, so that the CCO has the power to talk to the MD, CEO and talk to the audit committee. That is the idea. There should be interaction with the RBI, so that RBI can also be informed regarding the compliance risk in a particular bank. Now coming to the question. So this is it. Okay. Now coming to the first question, upon acquisition of a specified non-financial asset, the asset has to be recognized in the bank's balance sheet using a prudential valuation approach. At what value should the SNFA be recorded? Higher of the loan exposure or fair market value of specified SNFA arrived at least by the 2 independent valuers, fair market value arrived at least by 3 independent external valuers, original book value of the property, lower of the net bank value of the extinguished exposure or distress sale value. So whatever the option is correct, that you have to answer. Okay, so try to answer the correct option. Okay, out of A, B, C, D and E. Let's see how many of you are aware that how the SNFA should be recognized in the bank's balance sheet. Now coming to the next question, the RBI Compliance Function Directions 2026 require banks to establish an independent compliance function headed by the CCO. Which of the following is one of the eligibility requirements for appointment as CCO? So I hope you will be easily able to answer this question. There are a few data points that I have discussed with you that I hope you will be able to answer this question. So these are the 2 questions. Do try to answer the questions in the comment section below, and you will get the PDF of today's session in the Telegram channel of EduTap. So you will get the PDF of the session in the Telegram channel of EduTap, okay, as well as do try to give the answer of these 2 questions in the comment section below. So this is it for today. Thank you everyone for joining the session. See you in the next session now.